Hey, what's up guys? My name is Andrew. Welcome back to another video. Today we're going to be talking about 3 types of long-term investment portfolios that require very little management and actually outperform the market based on risk-adjusted returns. I'm going to keep this intro really short for today's video, so just make sure you hit the like button. I spent 2 days researching and it takes like 3 seconds just to like the video, and it massively helps out my channel. And subscribe if you want to see more content like this. Let's get right into the video. First up, we have Benjamin Graham, who's a really successful investor who actually mentored Warren Buffett, and he's relatively famous for writing the book, The Intelligent Investor. In the book, he recommends that you start off with a 50-50 stock-bond portfolio, and then you adjust it based on your risk tolerance, keeping it within a 25 to 75% range. Granted, this book was written back in 1949, so stocks were a much riskier investment, and a 50-50 allocation portfolio would have been relatively optimal. Based on today's standards, that would be pretty conservative, but nonetheless, it's still a really great option for long-term investors. So we're going to be taking a look at the different allocations between stocks and bonds, comparing 60-40, 50-50, and 40-60, which will be comprised of 2 different index funds, the total stock market and the total bond market. For Vanguard, the index funds are going to be VTSAX and VBTILX, and for Fidelity, it's going to be FZROX and FXNAX. For ETFs, it's going to be the VTI and BND. When we examine the 3 portfolios, the more stocks you have in your portfolio, the higher your returns, typically because stocks tend to perform better, but with more risk involved. When we look at the metrics from 1992 to 2020, the 40-60 stock bond allocation has had less volatility compared to 50-50 and 60-40. It also has a higher risk-adjusted return based on the Sharpe and Sortino ratios. When we look at the drawdown, portfolios with more bonds tend to have less drawdown, and this is a really big consideration during times of high volatility and recessions. Overall, the classic stock bond portfolio is going to be a very great long-term investment strategy for long-term lazy investors, and it also caters to all types of risk tolerance. Next up, we have Harry Browne's Permanent Portfolio, which is a recession-proof portfolio that minimizes drawdowns during times of high volatility. It's the ideal portfolio for retirees seeking to steadily grow their cash at very conservative rates of return. In fact, it's so conservative that 25% of the portfolio is actually kept in cash. The investment is divided into 4 uncorrelated sectors of the economy: 25% in the total stock market, 25% in 20-year plus treasury bonds, 25% gold, and 25% cash. When we compare the volatility between the S&P 500, Harry Browne's portfolio tends to be more stable since there's less volatility. When we look at the risk-adjusted ratios, we have a pretty solid return compared to the amount of risk we're taking on. The drawdown is much less during recessionary periods, so this further supports the resilience of the portfolio. Personally, I think it's a very solid portfolio with just one minor flaw, and that is to keep a portion of your investments in cash. The reason why I'm against that is because cash tends to devalue over time, and this is known as inflation. And so my personal recommendation is to put it into short-term bonds, and the ETF symbol for that is BSV. Or if you want to take on a little bit more risk and have a higher return, then you can stick it into intermediate term bonds, and that is BIV. When we compare the 2 variations between the short-term bonds and intermediate term bonds, the risk-adjusted returns tend to be slightly higher. So if you're able to tolerate slightly more risk for a higher rate of return, then I would suggest sticking it into bonds instead of just having cash laying around. Lastly, we have the legendary billionaire himself, Ray Dalio, and he is one of the most brilliant investors that has a very deep understanding in global markets. He also runs Bridgewater Associates, which is the biggest hedge fund globally, having about $160 billion worth of assets under management. Ray Dalio's long-term investment strategy is the all-weather portfolio, which is a 5-asset portfolio that focuses on 4 uncorrelated markets of the economy. So the portfolio is made up of 30% of the entire US stock market. 40% is long-term treasury bonds, specifically over 20 years. 15% is made up of 7 to 10-year bonds. 7.5% is made up of gold. And lastly, 7.5% is a commodity ETF that tracks the 14 most traded commodities. When we mash together these assets to create Ray Dalio's iconic portfolio, we get one of the most resilient portfolios that has survived the extreme volatility of 2 recessions. We can see that his portfolio is very stable, providing consistent returns during times of economic downturns, bearish markets, and extreme volatility. When we look at the metrics, the volatility and standard deviation is much less than the S&P 500, and so the all-weather portfolio won't have sporadic movements. The maximum drawdown for the all-weather portfolio between the times of January 2007 and September of 2020 is only about 12% compared to the S&P 500, which had a maximum drawdown of 51%. This is what the drawdown graph looks like. It kind of looks like stalactites in a cave, but the bigger stalactites you have, the more volatile your investment portfolio is going to be. When we look at the Sharpe and Sortino ratios, the all-weather portfolio has a significantly higher value than the S&P 500, so we get a pretty solid return at a very low risk. Overall, I think Ray Dalio's all-weather portfolio is going to be the top long-term investment portfolio for an individual to invest into, providing aggressive yet safe returns. As someone who looks up to Ray Dalio, I've incorporated a lot of his investment fundamentals into my own strategies and portfolio construction. So in conclusion, these investment strategies tend to be less volatile than the S&P 500, providing consistent returns for the decades to come. Although this might not be a style of investing, it's still very important to analyze the amount of risk you're taking on compared to the amount of returns you're getting. On top of that, investing into uncorrelated markets is key for diversification during times of recessionary periods. And those are my top 3 long-term investment portfolios. If you guys enjoyed the video, make sure you take the time and like the video. It massively helps out my channel, and subscribe if you want to see more content like this. Make sure you follow me on Twitter and TikTok to follow up to date. And if you want 2 free stocks on Webull, link down in the description below. Sign up, create an account, and deposit $100 and get 2 free stocks valued up to $1,600. And I'll see you guys in the next video.